Hi, good evening, everyone. Wonderful to see you all here today. It's a packed house. Wonderful that you could all come in on a weekday. Uh, and I'm really looking forward to this very interesting conversation because we've got three investors across three stages. So, we should be able to get a pretty comprehensive viewpoint. Back in 2021, raising money felt like a sprint, right? Um, Chase growth, show some scale, close fast. In 2025, the finish line has moved. In the last quarter of this year, Indian startups raised $2.1 billion across 240 deals, 40%, almost 40% less than the same period last year. But the numbers alone don't tell us the story. Investors such as these who we have with us, they tell us that capital has not dried up, simply that it has got more selective. The metrics which perhaps mattered in 2021 are no longer enough today. So the questions that we are trying to answer here today, what's actually changed in how businesses get funded? What is it that founders need to prove before they can actually walk into a pitch? And what's the difference between companies that are able to consistently close versus those who are unable to raise? So, my first question is to all three of you, and we'll start with you, Anirudh. Uh, what is the non negotiable in 2025? What is it, that founders could have possibly, uh, you know, done away with in 2021, but it is imperative today?
First of all, good evening, everyone, and thank you. That was a great way to set up this conversation. See, I don't think 2021 was the norm. This is the norm, right? This is how investments are actually done. As somebody, I mean, I come from a stock market family, like 45 years in the public markets, and you see these waves in the public markets, where sometimes money just seems to be free in the public markets. Sometimes money seems to be very expensive in the public markets. As anybody's lived through 2012 to 17, I mean, think about those P's. And so what we did, we had a lot of free time, by the way. From 22 to 24, Artha didn't invest much because we just saw the market was super overheated. We would meet founders who said, you know what, listen, I need an answer by the end of the day because I have another term sheet coming. And we thought they were kidding, but they were actually right. They actually had a term sheet coming. And I thought it was just too much money, way too much money. And people super excited, maybe because a lot of people were sitting at home as well, right? Because they were super excited to just deploy capital.
Right.
But no one was asking the right questions. Where is the customer willing to pay for what you're providing? And I think what has always been non-negotiable for me is that if you as a founder are better at chasing a venture capitalist than chasing a customer, then you're not the investment I want to make. Because the more perennial source of capital is the customer. If you chase the customer and the customer keeps coming back to you and buying more and more and more, I promise you, every single venture capitalist in this room will be chasing you, right? And this has worked in history forever. The best deals are the ones where the VCs chase you, right? You want the best valuations? Get the VC to chase you. And guess how you get a VC to chase you? You chase the customer, right? And that's how the VC chases you. So to me, that's always been a non-negotiable, and you're seeing that now. You're seeing a lot more profitable companies. Yes, 13,000 startups died this year. We all know that. What's a metric we haven't looked at? So we analyze, and I'm sorry, taking one extra minute. We analyze around 16,000 rounds of capital since 2014, right? 16,000 rounds of capital roughly have been raised in the last 11 and a half, 12 years. And we were like, in the public markets, we always say, agar P high hai, to market is bull run, P low hai, to bear. Why we don't have anything like that in the venture capital? Anybody? Like, Yagnesh, do you know any metric like that? We don't, right? So we said, typically it takes 3 years between seed to series A. So you should look at that as a cohort, right? And we call this a graduation rate. If you raise the next round of capital, you graduated. If you went from A to B, graduated again, B to C, graduated again. The typical graduation rate over the last 12 years, can anybody name, if 100 startups raised a seed round 3 years ago, how many of them would raise a series A within 3 years? Too high. Too low. Wow. Perfect. You just averaged it, but it was right. The
You're
a-
Thomas guy.
the average rate of a company, a cohort from seed to Series A over a 3-year period is 12%. Do you know what that rate was in 2021? Who said?
Numbers guy?
It's close to 35%.
Wow.
Did the startups get better overnight? Right? It's just a lot more money was chasing fewer ideas. You know what the graduation rate is right now? It's 5%. The startup did not get worse overnight either. It's just that people have lost a lot of money. Even in the A to B conversion, usually 1 out of 5 startups goes from A to B. Right now, the conversion rate is 1 out of 20. At the peak, it was 4 out of 5. It was like, if you got an A round, you're guaranteed to get a B. Just burn the capital fast enough. Right? Founder will be like, the question, how fast can you burn? Can you burn 3 crore a month? If that if that is how startups being metrics are being announced, that's wrong. I think we've actually come to the bottom. There will be a mean revert. Things will come back to normal. But that was also like a crazy time.
It'll be a new normal. Abhishek, your point of view.
Yeah, no, thanks. Thanks for being here. No, I think I somewhat echo the point. Things were not normal like in 2021. This is more what normal looks like. But I would extend that argument that the metrics that matter haven't actually changed. What has changed is how selective, because the risk appetite of the capital has changed, and hence how selective we want to be in investing in a particular company, that has changed. So growth remains the most important metric that a startup should chase. Ultimately, these are small businesses, they have to grow. But context of that growth matters. Are you in the top decile, top quartile in your segment? Yes, then that's great. Maybe 2 years ago, that would have been okay. You can be the median and still raise.
Correct.
So who raises within a segment matters. Obviously, the correlation of you being able to raise to growth was probably 90% in 2021. Now the correlation has moved to maybe 60% growth, 30 to 40% unit economics. Again, not profitability. I think if at early seed stage, at Series A, Series B, Series stage, I don't think VCs are looking for you to be profitable. We are looking for you to grow fast, but showcase that path to profitability. And the correlation to that has slightly grown. It still remains that growth is very much required, but at what cost, and hence how much burn. I think that has changed marginally towards what it should be.
Right.
Versus very free flowing capital.
Right. So the metrics have also expanded. Just the number of metrics have also expanded of what you're looking at.
Partly, yeah.
Yes. Raja.
Yeah, I agree and echo both of their comments. I think for us, the metrics more or less have remained consistent. I think there was a lot of FOMO-driven investing, primarily more on the early stage side of things. For us, when we are looking at it, I think taking on Abhishek's point of view, paths to profitability and quality of growth, sustainability of the economics, unit economics. I think those were some of the factors that we care about a lot more. And as we go towards more and more maturing companies, the market structure, the dynamics around regulations, the dynamics around how you think about market share, growth of the market itself, those become more important factors for us when we are thinking about the investments from our point of view.
All right.
So yeah, I think that also is a function of the stage of the company. So I'm sure Anirudh looks at different metrics that we look at. So, but yeah, that's how it is.
Yeah, no, you've got a pretty comprehensive viewpoint, but let's flip that argument, okay? Let's see it from the perspective of the founder. What is it that they seem to lean on too heavily, which may not actually matter in terms of the metric that you're seeing?
How much time do we have?
For this one, not a lot.
Want to start the other way?
Anyone can start. Rajat?
Yeah, I would say growth is like focus on just that growth number without the what is below that growth number is something I feel a lot of times that we focus, that the founders focus on in a lot of our conversations. I think that's the number one metric for.
I actually want to build on that. I think growth and not focusing on cash flows.
Cash.
They,
All right.
you can show whatever sales metric you want, But if you're in a business where collections are not happening, that sales number is absolutely incorrect, right? But the burn you're making is absolutely right.
Yeah, Anirudh, I agree to that, but cash flows number come at a much later stage in the company. Like even for a company that we are looking at, probably the cash flows probably aren't there.
No,
But what I'm
in a
looking at,
different way. Imagine I have sold something,
yeah,
but so in this month I sold 1 crore worth of stuff.
yeah,
Now it is with 100 retailers who haven't paid me yet.
that's not business. That's
But I'm telling you, this is a lot of things that we see a lot of times, that you in the quest for growth, you start giving out credit to the market. It looks all great till you have to go and do collections.
no. So that is basically the funding can happen not just by investors but by your channel partners. It's a way of doing that.
Vendor financing, not venture financing, right? But
Abhishek.
No, I'll say, broadly two things, right?
Yeah.
One, growth is important, but if you drill 1, 2, 3 layers deeper in the quality of growth, right? Have
Right.
you gone just added more products and that's why you're growing? Just added more geographies, that's why you're growing? Is there like for like growth, what we call in VC terms, is that happening? So going 1, 2, 3 layers deeper into how you're growing matters a lot.
Oh yeah.
I think second part is that founders by definition are like highly inward. They care, this is their baby, they care about it. They spend 24 hours a day thinking about their company, but also thinking about what's happening outside in the market. Like, how have my competition changed? How has what does good, bad, ugly look like in my industry? I think that founders should be can be always more aware of, which is not typically their day job, but should become. And that's why I think getting feedback not just from VCs or any advisors, not just when you're raising, but engaging with them over time.
2 hours. Yeah.
Yeah,
That,
so you don't have to just go to the investors and talk, I'm raising right now.
All
Right, that's probably never a good idea.
all right. Next question again to all of you. We often hear that founders are told, right, choose your investors wisely. But it cuts both ways, doesn't it? Because as investors, you're also choosing the kind of capital that you want to be. So in 2025, what defines good capital for you? If it has changed since 2021 at all, is it patient money? Is it disciplined money? Capital that helps build. Anirudh.
I think so. So I'll give you some examples. Like, for example, we invested in Beardo, right? And if you ask the Beardo founders, I think total round was 6 crores. I don't think they ever used the money. They just wanted the confidence that there should be 6 crores in the bank account. I did a podcast the day that Marico bought them out with him, and he said it very clearly. You know what? We actually never used the money. Just sat there. I just needed the confidence that something was required. Ki paise hai, right? And I think many of the times where I see the capital has to be patient. The capital definitely has to be extremely decisive, and you need to know. And I read this amazing book, and I now I'm giving it to everybody. It's like, measure what matters. Are you measuring? Many of the founders hate measuring, and I don't know why. Because any Marwadis and Gujaratis here, right? For a fact your parents look at their trial balance every Friday. I don't know why founders don't do that. I think if you just did that every Friday, it is almost impossible not to make money. Because you'd know from a week to week basis where your balance sheet has moved. And you know what you did that week, and it's very easy to understand. It's like if you stood on the weighing scale every morning and you gain 200 grams today, you start thinking, oh, gulab jamun nahi khana chahiye tha. Right? So I'm simplifying it too much, but I'm telling you, it is just the fact that you don't measure. The founders that don't want to measure, the founders who don't want to report, the founders who only want to talk about good stuff, I'm seeing those are the kind of founders who get into a tangle. And the ones that, like, second time founders, third time founders who've done it for the last time, the second time founders are so good, their reporting is like a muscle for them from day zero. And they're moving at a much faster clip. We've had 2 companies in the last 6 months have raised second round at 5 times the valuation within 6 months. So if you're telling me there's a problem, there's not a problem. But those founders are the ones that every week, every month, their MIS, their banking statements, they are in a folder, they are ready.
Right.
That
Be
is
obsessive
non-negotiable.
about Abhishek.
No, I think when it comes to choosing capital, obviously it's a self-selection, right? Investors are choosing the company. The company is choosing, in most happy cases, investors as well. So I think aligning what kind of investor, what kind of capital you want is very important. It's very, very much okay that you don't want an active investor. And that happened a lot in 2021, right? That people didn't ask for board seats. Even now, some investors don't. And if you want that kind of investor, go for it. Many investors actively want to be involved. They want to create value. That is part of their operating principle. So you should just know that beforehand, and not get into a sort of a marriage with an investor and then, oh, they will give me advice, right? And they will tell me this metric is good or bad. Like, so just aligning that, okay, what kind of investor there is. There will be some investors who want to be away, want to let founders do what they want. There will be investors who want to be very deeply involved. Just marrying that is very important.
Rajat, to you specifically, what should a founder be wetting before he actually says yes to a term sheet?
To a term sheet. Okay, so this is kind of building on to that question, but I'll respond both of them together. I think this is a question that is probably not asked enough, that who should a founder raise from? The quality of the capital matters more than the capital itself. Like, I think one of the founders we have backed is sitting in this room, but like every company that we want to back, I literally tell the founder, please go and talk to my portfolio companies. How do I work with them? The founders of those companies. What's the value that we bring to the table? What's the kind of engagement that we have? Are we intrusive? Are we helpful? What's the value that we bring? For example, like when we are coming into the company, what's the value? The number one value that we bring to the table is we are being a sounding board to the founder. There are strategies that he wants to implement, capital allocation decisions. Those are areas that we can help the company. We can't tell him marketing kaise karni hai. We can't tell him business kaise chalana hai. What's the other thing? We help him bring the right talent on board, from a board perspective, from a management perspective, from a CXO layer perspective. We help him take the company public. Having a good investor on the cap table brings a very different perception in the capital markets. That's the significant value add. Helping them on the regulatory front. What's your how do you work with the regulator? How does the regulator view you? If particularly if you're in a regulated industry. So those are some of the areas that we care about a lot. We actually tell our founders, why don't you go and talk to our portfolio companies, speak to them, they'll connect you, figure out your ways if you want to. But that's something that they should do more and more, I think, which is probably not being done enough.
Not being done enough. All right. I want to talk to you now, focus on what you're doing, Abhishek. You sit in the very crucial middle ground, right? Series A to Series C, C+, where founders have had some traction, but they now need to prove that they can consistently, and scale efficiently, perhaps. Everyone is telling us that profitability is table stakes. So when you are evaluating these growth stage startups, which are the operating metrics that really drive your conviction? And I just have a few for you, and you can expand on them or, tell us your own. Is it repeat revenue? Is it retention? Is it free cash flow? Or something else?
No, I think, like, just to set context, right? Typically at Series A, people are finding early PMF or they've just shown PMF. Becoming Series C, Series D means that you have shown scaled PMF and now you're ready to becoming an independently large company, right? So what that essentially means is that you've done something right at small scale. Can you really make it larger without breaking things down? You've acquired 1,000 customers a month. Can you acquire 10,000 customers a month? You've been in one geography, one product. Can you go to 5 geographies, 5 product? And then obviously these metrics will apply to different segments. Like, do you, in a B2C segment, where it's a highly frequent business, you want to look at retention rates because ultimately you want to look at payback on your acquisition cost and all of that. But ultimately what Series C is, how Series C is different from Series A in maturity terms is that how much have you scaled it?
Yeah.
How much de-risked are you as a continuing business? Which typically means, okay, I was just a single channel business at Series A. Now I'm a multi-channel business at Series C, right? I was a smaller brand at, inbound in terms of, getting referrals, getting organic customers were lower because not enough people knew about me. Now that has scaled, and I've become a much larger brand. So these are the things that sort of graduate. There's no black and white line of graduating, just showing it at scale. And some of these metrics will apply to specific business, whether it's retention rate. We care about in consumer businesses retention rate a lot. I don't think we're looking at, again, profitability. We're looking at, do you recover money that you invest in to acquire either a B2B customer or a B2C customer in the right time frame or not?
All right.
And have you repeatably shown ability to acquire customers? So ability to acquire customers repeatably and recovering the investment you've made, these are the two broad areas that you should think about, and doing it at scale.
All right. A follow-up to that is that are you seeing startups now actually re-architecting their models, say, compared to 2-3 years past, or are they simply repackaging it, around what you're saying? Are they re-architecting their models around what you're saying or the advice that you're giving them, or very often are they just repackaging it for the current climate?
No, I think it's more of a repackaging than re-architecting, and it's not needed. If the business fundamentals are right, they are right.
They're right.
The only thing that's differing is, do you want to be consistently in a fundraising environment? Do you want to raise your next round 12 months, 18 months down the line, or 3 years down the line? And the capital, perhaps the environment determines that, which means you have to manage your cash flows, you have to manage your burn. So you somewhat notch down your ability to scale and ability to burn money, so that you know that you have enough time between now and the next time you will need money from investors, right? So you prove more things and take longer in an intended manner. So I think you're doing the right things, but taking longer and showcasing it for slightly longer. Like, growth of 2 quarters doesn't cut it anymore. You have to show consistent growth over 4, 5, 6 quarters. And hence, knowing that you've raised capital and that capital can sustain for that long is important.
Okay.
So you slightly tweak your model accordingly.
All right. Okay. Anirudh, we've been talking about now companies with Abhishek, which have shown some traction. There is some proof, but you're betting much earlier, right? At seed stage. And sometimes you're simply betting on a deck. So what does conviction look like in the absence or when there is barely any data?
So correction is that we don't invest in at that early. We usually come in at revenue stage. It's like a seed plus 7 to 10 lakhs a month in revenue. Our average has been about 15-20 lakhs. What we're looking at is that when you got that 10-15 lakhs of sort of your beachhead customer base, what's the unit economics looking like over there, right? Is it proving whatever you're putting in your deck, that hey, I have 70% gross margins? Is it proving that? We're looking at, hey, with the quality of the customer you've got, is it matching with the ICP that you put in your deck, right? We just want that validation before we start giving them the first 4 crore check. Now, the way we tell them is this 4 or 5 crore check I'm giving you is just a first check. I will lead your next round. I will give you another 10 crores in pre-series A myself, and I'll give you another 20 crores at series A, and I'll help you find the lead. But what we want to see is that ICP, if you've proven that this ICP works, or you figure out something along the way. Many of these businesses will pivot, and they should. But the point we're trying to make is between that seed to series A journey, and I feel by series A, a startup should be very clear what's the number which I hit profitability. I think that's when you get out the valley of death, which is that seed to series A is your valley of death. By series A, you should know exactly what number do I need to hit, and what needs to happen when I'm finishing my series A round, that I will be profitable if X, Y, Z things happen. There always will be variable that I'm saying, but you should be fairly certain with that. So to us, I think with every round, we are trying to understand that is the founder able to prove that the thesis with which I started, is that actually panning out? How am I pivoting, or how am I, cross-correcting along the way? And by series B and C, these companies, and the best ones that we've had in our portfolio, are the ones that have already now said, listen, we know we're going to be profitable. In fact, I would say in Fund 1, 3 companies, all 3 Series B companies are profitable.
Right.
PAT profitable, paying taxes. And it's just that they discovered at Series A that this is what I have to do to be profitable. And as long as I keep doing that, I can build a 2,000 crore top line business and have a 300 crore PAT. I think that's a brilliant business to be at 50 crore valuation, right? Because you're obviously going to make a lot of money doing that. So I think the metrics for us have been a little more different because we're more of a Dhanda investor, not typically, in the, and I come from a door-to-door sales background. So for me, knowing who your customer is, knowing that, hey, let's go figure out how we're going to sell this guy. I want to be in the sale. I want to listen to you, listen to the customer saying, hey, I don't like this, and this. How can we reverse engineer? So getting involved really helps the founder, navigate this journey much faster. I also feel, and I'll add this, the faster you navigate this journey through profitability, the lower the dilution. And one of the things that we've been really proud of in Fund 1 is each one of our Series B founders today owns more than 40% of the company, which means that they have generated fantastic wealth for themselves. They're not sitting at teens, they're sitting at high ownership numbers where they can literally make a huge impact to themselves. And I really pride that, at least as a fund metric for ourselves, because that means that I no longer have to manage the founder. The founder realizes I have a 2,000 crore company, I own 800 crores of equity. Trust me, he'll manage it, or he or she will manage it way better than I can ever, once they realize that's the level of wealth I've built for myself.
What convinces you that this founder is ready for your money? If you can give us a list of characteristics, would it be founder execution speed? Would it be revenue rhythm? What would it be?
It depends upon how much time I have with the person. If you're saying at the first look, what really gets me with the founder is that, do they know their numbers, right? That when I'm asking them and that, listen, what was last month's sales? And then if they don't know that number right away, I have a genuine, I want to know what was last week's sales, what was yesterday's sales, right? Where are you sitting? How much cash do you have in the bank account? Are you, like I said, are you measuring everything that matters? Right?
Okay.
I'm not saying that, again, and no one is saying you're going to be profitable at seed. But do you know, and are you worried about that daily number?
Yeah.
Right? Any Marwadi guy, any Gujarati guy knows yesterday kitna galle pe kal kitna bika tha, usko pata hota hai. I just think the founders who think like that get to the numbers faster because they're thinking and almost manifesting the right things.
All right. Rajat, you come in at the other end of the spectrum, right? Growth equity, IPO track businesses. By the time a company reaches you, what must be bulletproof?
Corporate governance, number one. Either profitable or paths to profitable. Like, I don't know, or like I should be able to figure out at least how the company is going to be profitable if they are already not. And scale. That's, I think those are the most important things. Apart from that, like these are the baseline things. Apart from that, we of course we will look for growth potential, market structure. Can this company go public? I think that's also one of the important things that we look at. Like there are a lot of companies which are good, but I don't know if I can take that company public, or will there be enough takers for that company in the public markets? So like a lot of times we actually call out analysts, public market analysts, and ask them that what do they think about a business model like this? What do they think about a company like this? Can this company, would you buy this if this company goes public? That helps us quite a lot in thinking through some of the things that we look at. So yeah, I think those are some of the key things. Apart from all the, I think metrics are all similar only. But yeah, those are some of the additional things that we will look at.
You mentioned companies which are on an IPO track, for instance, and if you spoke
they don't have to be on an IPO track. They can be taken IPO if need be.
Okay.
Like I can't, like it doesn't have to be that the company, like there could be a company which might not be public in next 3-4 years. Right. That's okay. Like I'm not looking for a company just before the IPO stage. I can back a company which is like 5 years away from IPO. That's fine. But it has to, it should be a company that can be taken public, at least.
What are the 3 core signals that tell you that this company is ready for IPO track?
Scale, runway, and favorable market dynamics.
Okay. All right. Okay.
Like if a company can grow at 15% for 15 years at a certain scale, that's absolutely a company that you can take public.
Okay. Okay. You worked with GIC, you worked with Carlyle, now with General Atlantic, all with global mandates. Can you tell us, whether you think that there is any Indian sector or perhaps even a business model that has genuine global relevance and not just, domestic strength?
Many actually, like global relevance. Like for example, if you look at, there are companies in our portfolio like of TBO and Amagi. They're building vertical software for the global markets. Like TBO, we invested in the company 2 years back. They're building travel software for the global market. More than, I would say, I don't know if the numbers are public, but majority of the revenues come from global market. India is, and they are completely based out of India. They have done multiple acquisitions globally, from Europe to recently they acquired a company in US. So that's a very big area and very big focus area for us. We are taking another company public next month called Amagi, which is a similar company in the broadcasting space. They create softwares or technology platform for broadcasters, similar kind of domain. Then they have a company in the marketing space, which is called Pixis. Again, similar thesis. They're building products for the global markets out of India. And I'm not just them. I think Freshworks and Zoho and Zenoti, all of demonstrated those. That's an area I think where Indians have demonstrated, and it's not like this theme right now. It is theme running since 90s, since the days of Infosys and TCS. They started more from a services point of view. Now it's becoming more products point of view, but that's been a global theme. I think one thing which we probably don't talk about enough is the entire payments infra in India. That's being a regulated industry, you cannot replicate that easily globally. But I can say for a fact that a lot of companies across the world have just copied what Indian government have done in UPI. For example, I know a lot of...
The entire stack and the way that it actually makes ease of payments.
Yeah, the real-time bank-to-bank settlement, that core concept is just... at a scale that UPI is doing or NPCI is doing, it's unimaginable. Like I know, like Brazil, for example, copied Indian stack. A lot of companies are taking NPCI's help to build similar kind of ecosystem in their countries. So while this is not something that NPCI is probably working and collaborating with some of them, they cannot replicate and put UPI in their countries because of the regulated nature of the industry. But otherwise, it's an innovation that has seen unparalleled thing in the global market.
Yeah, and kudos to the entire setup that has actually executed it.
Correct.
And made it so much easy for so many of us.
And consistently, they have been innovating at a pace that's like, you started with just a small UPI real-time payment, then they started credit, then they started offline, they started UPI Lite, they started international. The kind of innovations that keeps on coming in the UPI space, it's impressive. It's pretty incredible.
All right. Last question now to all of you. Okay. So if a founder walks into your office, maybe tomorrow, next week, whatever, what is the one thing that you'd ask them between metric, mindset, and mistake to nail before they asked you for capital? You want to start, Anirudh?
Metric, mindset, and...
Or mistake.
I can choose one.
You can choose one.
Okay. No, I for me, it will always be the mindset.
Mindset.
I want to know why is the founder in the game? And is there a personal passion for it? Especially in these kind of markets where due diligence timelines are running at, I think, average 6 months, I would say. Do you have enough fuel in the tank, not just in the bank account, but do you have enough fuel in the tank to go through a 6-month due diligence process? Because in 21, we were used to a 2-day due diligence process, right? Which meant that I met you today, wire the money day after tomorrow. But I think that's the time when you figure out that there is a burning passion for the founder, because the founder always looks at the world that something is wrong in it, and they have a viewpoint that has to be executed. And the founders that work with that, they work day and night. You don't have to call them up and ask them. You know that they're at work. And to me, that mindset, if I can evaluate that in one session, hopefully, that's the winner for me. Everything else, we can definitely work with the rest.
Abhishek?
No, I think it has to be a mix of metrics and mindset. Metrics do matter. Like ultimately, like the one thing we'll ask for, can you show me PMF? and it's a very qualitative thing, but end of the day you can figure it out. But mindset is very, very important. I think, why are you the person who has identified the problem in the market, and why are you more uniquely positioned than 10 other people who will come in? In India, either in B2C, B2B, there will be competition, right? You have to live with it as well. So you have that hunger, desire, but also unique insight in the market that you are better placed to do it. And that is the more challenging part. Numbers, you can see, like in most cases we meet the founders, we know the numbers beforehand, right? So you're meeting the founders to actually know why they are doing this and why do they think they will be successful versus others to do it. So that is very, very important.
Yeah,
Just
I would.
last word.
No, I would agree with both of them. I think mindset for me also is the number one thing. When we are looking at metrics, it's just a way of validating what the founders is talking about, what he believes, the quality of the team. Are they able to deliver and execute what their vision, their business model that they have, and even the mistakes? Have they done mistakes? Have they learned from them? Are they open about it? Like, I really admire when in a management meeting the founders or the company talks about, okay, these are the things we tried, didn't work out, we shut it down, we lost some money, but that's okay, we moved on. So that's absolutely perfect, because that gives me an insight into how the founders are thinking, how the
Right.
team is thinking. So their mindset is absolutely the number one important thing, and everything else is a way of validating that.
All right. With that, thank you very much, all of you, for joining us. We've had 3 founders, 3 different stages, but they've given you one clear message. Capital is there. It's a little selective. The founders with discipline, who move beyond the hype, will be the ones that will build the category-defining companies of tomorrow. And I hope that all of you in this room, will be those people. So thank you very much. Thank you.